Your cursor hovers over the entry button. 3 seconds. 5-minute candlesticks drive into a level you've mapped on TradingView. Level 2 brightens, the tape speeds, your breath turns shallow. You promised you'd wait for the first pullback with a stop loss behind structure, but a tall green candle slices across your P&L and whispers, now or never. 1 second. Your mouse creeps. 2 seconds. Chat room scrolls. Go. 3 seconds. Click. You're long at extension, not at value, donating liquidity as the market inhales. Price snaps back. Your position flips red, and your brain flips mode from trader to hostage, staring at the widening gap between entry and plan. Your finger moves, not to exit, but to cancel the stop you swore to respect. A wick hunts the level, your margin meter blinks, and platform feels like ice. You know this scene because it repeats. The 3-second FOMO entry doesn't just hurt your P&L, it trains you to prefer relief over process. Most traders lose money. This is educational, not financial advice. Past patterns don't guarantee future results. Risk management is survival. In those 3 seconds, the market isn't your opponent. Uncertainty is. Your eye sees a breakout and your brain promotes the last few candlesticks to prophecy. That is chart pattern hallucination. Mistaking a sample for the story, you know better on paper. You've read that a setup is a probability statement, not a promise. Yet the need to avoid missing out hijacks the frame. Mark Douglas warned that craving to know what happens next is the seed of error. The market pays traders who accept not knowing and taxes those who demand certainty. The moment you click at an extension, you're trying to purchase certainty with a worse price and a looser plan. Inside your head, a fast negotiation is happening between beliefs and biology. Dopamine fires on the tiny preview of gain, stamping the button as a source of relief. When the first tick moves against you, cortisol narrows attention to threat, and adrenaline shoves you towards speed over quality. Mirror neurons compound it by echoing the urgency in feeds, rooms, and alerts, converting other people's conviction into your anxiety. Your prefrontal cortex, the part that holds rules, checklists, and nuance, gets outvoted by older circuitry that wants the discomfort to stop. That's why you tighten stops at the highs, remove stops at the lows, and extend exits on the first sign of green. Brett Steenbarger has written for years that performance collapses when attention turns inward to your feelings rather than outward to the auction. Value acceptance, rejection, and who is in control. Focus on yourself and you will feed the loop. Focus on the bid-ask dance and you will interrupt it. Here's another piece most traders ignore. Social proof makes bad prices look safe. When a breakout candle is clean, it attracts the widest audience. Stops cluster in the same obvious place because humans cluster. Large players know this and use the cluster as liquidity. Perfect setups can fail precisely because they are perfect. The paradox deepens. The best trades rarely feel good. They often feel uncomfortable because you're entering when emotion is cooling, not heating. More analysis can make you worse if it becomes attachment. Every new confluence you add increases emotional investment. So the moment price moves against you, you defend an identity, not a plan. Tighter stops can produce bigger losses because you keep getting clipped, then re-entering worse, until a normal retrace becomes a day-long drawdown. More screens can create less clarity by multiplying noise and urgency. Trading Psychology 2.0 reframes this as a behavioral system. Emotion is not the enemy. Unmanaged emotion is data misused. Your fear, greed, and boredom are signals that risk has shifted or attention has drifted. Mechanical rules protect future you. Accept randomness and your execution finally becomes repeatable. Most traders lose money without such boundaries. You scan through watch list names while pre-market volume builds. A stock presses yesterday's high. The 1 minute shows a tight flag under resistance. The 5 minute aligns with rising moving averages and steady volume. The hourly is reclaiming a prior breakdown zone. Your plan is straightforward. On break, wait for the first pullback into the flag top, place a limit entry, put the stop loss below the base, and target the next daily level for a 2-to-1 risk-reward. Then the break comes hotter than expected. The first candle launches. The second gaps a tick above the first, and time and sales becomes a hose. You hesitate for one candle entry. Hesitation paralysis, watch price stretch, and feel the distance to your planned stop double. Instead of halving size to keep risk constant, you hit a market order to catch it. Now you're long with poor location and worse size. Order flow fades, the stock revisits the breakout level, and your unrealized P&L bleeds a small red. Cortisol whispers, it will bounce. Hold. You cancel the stop. A wick drills under the level, harvesting clustered stops. You add, calling it a starter to fix your price. Revenge trading loops activate. A lower high prints on the 1 minute. VWAP rejects. The bid slides. You widen the stop, then remove it. When you finally capitulate, you've converted one planned trade into a sequence of undisciplined entries and exits, torching a day that was supposed to be small risk. Later, you tell yourself the setup failed. It didn't. Your behavior did. This is how tight stops become losses, how overtrading compulsion sneaks in, how weekend holding anxiety gets born from one afternoon of regret. The pattern is expensive not only in dollars, but in confidence. The market did nothing unusual. Your reaction turned risk into ruin. Enter Marcus, the risk manager. He used to scalp everything that moved. Now he sizes first and decides second. 3 monitors, nothing flashy. Left, daily, hourly, and 15-minute charts with clean support, resistance, and volume profile value areas. Center, execution platform with level 2, time and sales, a DOM ladder, and a simple bracket template. Right, trading view with alerts parked at predefined prices and a stripped-down watch list. He hides his P&L and keeps his journal open. His mantra sits on a sticky at eye level. Risk defines the trade. Marcus blew up a small account years ago by chasing. He can recite the mistakes. Moved stop loss 3 times, added on red, scaled out on the first flicker of green, doubled size to make it back. He had read the classics Douglas on probability thinking, Steenbarger on performance routines, The Way to Trade on mechanical execution, Psychology 2.0 on turning emotion into information, Market Wizards on humility, but he hadn't built their ideas into clicks. He was still letting 3 seconds decide. The wake-up came from numbers. He downloaded 3 months of fills and tagged each entry. Impulse. Any order placed within 5 seconds of a momentum burst and more than 0.5 ATR beyond the last base. Plan. Everything else. The histogram was ugly. Impulse trades were a small minority of his sample and the vast majority of his losses. Plan trades were boring and profitable. He overlaid footprint charts and saw absorption at the very spots he used to buy. He overlaid volume profile and saw he was paying up at low volume nodes that often invite reversion. Emotion wasn't lying to him. It was just speaking the wrong language for entries. So he rebuilt the trading day around constraints that protect him from himself. He starts pre-market with a 2-minute breathing drill, a quick mobility stretch, and a 1-page game plan. He writes 1 sentence per name. Bias up on hourly. Want, reclaim, and hold of value. Entry is first pullback to VWAP if buyers keep lifting. He sets alerts at the break level, the first pullback zone, and the second chance zone. Then he closes charts. 5 boxes must be checked for entry. Context aligned, location near value, order flow confirms, stop loss at structure, and at least 2-to-1 risk adjusted reward. If any box fails, no trade. Marcus's rewiring lives in procedures, not pep talks. He treats entries like a pre-flight. Before the bell, he defines setups on higher time frames and writes the invalidation first. Each candidate gets a location map, breakout level, first pullback zone, second chance zone, stop loss behind structure, and the add-on trigger. Alerts replace staring. If price reaches his zone, an alert drags him to the screen. Absent that, he does nothing. He uses a bracket order template so the stop and target deploy with the fill. He cannot cancel the stop with a hotkey. Size is derived from risk per share, not from emotion. He reduces risk after a rule break and earns it back only after a flawless sample of trades. He keeps his P&L hidden and reviews it only after the session. His 3-second defense is a chain. First, the 20-second rule. When an alert fires on the initial break, he waits and watches the DOM and footprint for continuation or absorption. Second, the checklist. He must literally point to context, location, flow, stop, and risk dodge reward. Third, the breath. 3 slow cycles, inhale 4, hold 2, exhale 6 before clicking anything. Fourth, the language. He speaks the plan out loud: entry, stop loss, exit conditions, so the prefrontal cortex stays online. Fifth, the boundary. If the entry would occur more than 0.5 ATR away from the base on the execution timeframe, it is forbidden. Emotion isn't expelled, it's sampled. Trading Psychology 2.0 calls this turning feelings into data. If he feels a strong urge to chase, he tags state as hot and automatically cuts size in half. If he feels bored, he assumes attention drift and rereads the plan. Steenbarger's performance loop guides the post-market. He exports fills, marks each entry as plan or impulse, and writes one sentence about state: sleep, stress, caffeine. He highlights any stop-loss movement. He then drafts a microfix that can be measured the next day, like no trades between 9:45 and 10 timos unless checklist complete. The way to trade supplies the tone: mechanical compassion. He builds rules that protect future markers from current markers. Market wizards supply humility. He expects to be wrong and designs exits. Transformation does not look like fireworks. It looks like a quiet face during a fast tape. Marker still feels the tug when a candle rips, but the breath creates space, the checklist creates criteria, and the bracket creates friction. Missed moves sting for a moment and then pass. Planned entries feel a little uncomfortable, and then work or fail without drama. He lets price come to his levels. He lets stop losses trigger without commentary. He lets exits happen where structure says, not where P&L pleads. His drawdowns exist, but they are plotted and sized. His winners extend because he stops cutting them for comfort. Most traders lose money because 3 seconds own their day. Marcus buys those seconds back with rules. He knows past patterns don't guarantee the future, so he treats every setup as a probability statement and judges himself by execution, not outcome. He accepts boredom as the tax on clarity. When the squawk shouts and chat erupts, he watches the auction, not the crowd. He buys no certainty. He rents risk at a price daily, consistently.